pick a hard money lender on your flips? It's a very, very difficult question. Before working with a hard money lender, you definitely need to do your homework and get your ducks in a row up front so you know exactly what to expect and you can get through all the bad lenders to get to the good ones. Just like any team member in real estate, it's all a matter of who your team members are and vetting the good ones and being able to work with the right people that can get your deal done and get your deal closed on time. So today, I'm actually going to cover a number of things. So what are the attributes of a hard money lender that you should be looking for when you're doing your flip deals? What are the scams and pitfalls that you need to look out for when you're working with different lenders out there? And of course, how to compute your math, how to actually go through and break down what to expect out of pocket and how much you need to be setting aside for the capital requirements of your deal when you're doing these different projects so that you don't run into a situation where you run out of money or have to come up with more money and can't get a deal closed because you're not sure exactly how to break that math down. Okay, so my name is Mathew Owens. I'm a California licensed CPA. I've flipped over 1,000 houses now. We have over $35 million lent out to flippers in different markets around the country. We do a lot of value add multifamilies and different syndication investments and do a lot of different passive deals as well across the board. And we deal with the operations quite a bit and understand the flipping process as well as the lending process very well and what problems we see a lot of different borrowers have happening through their deals with other lenders or not coming with the right documentation for us when we're trying to do those deals as well. So I'm going to take you through some of those attributes of first, what makes a good hard money lender in the first place. Okay, so first is understanding their underwriting and approval process. Okay, so being able to know, hey, once you submit that deal, how many days does it come back from underwriting with a general understanding of here's your basic quotes, here's your basic programs that'll work with you. We've already vetted the market value, vetted what the renovation costs are going to be, and looked at those numbers in detail to say here's your basic information here to say this is what I think we can fund in the first place. So that could be as long as a week process or a day or 2-day type process, or it can be very much automated based on the programs that are out there, subject to reviewing the appraisal on the back end or the renovation on the back end and even more detail. So sometimes when you get that speed, they may not have looked at the full market values or the full renovation in detail, of course, when they're looking at your deal. So knowing that up front and knowing what that process looks like, what does it expect, what do you expect from a communication standpoint, and that type of thing is absolutely important. Okay, so one other thing to really look out for is who are their funding sources. There's a lot of brokers out there that are not direct to the funds. They don't have their own funds and they are subject to the different limitations of their funding sources in the first place, where these other funding sources will either buy their paper from them or they go through and table fund the loans directly, where the broker doesn't have to actually fund those deals in the first place. And so understanding that, hey, yeah, there might be some limitations there if you're working with a broker that doesn't have their own funding source. We have our own in-house funds at our company. When we're doing different lending, we also utilize outside lending sources as well, the different people that buy paper from us and table fund and do different projects for us. But we have our own in-house programs, so we know those unique deals that can come up, and we can fund those types of deals from an investor standpoint and understand what investors see, because we've flipped 1,000 houses ourselves, of course, as well. So understanding where those funding sources are really important to know how reliable are they going to be with actually closing when they are subject to potentially having to go out to these outside sources, of course, as well. Now, that doesn't mean they're not reliable. Many times these brokers know their stuff really, really well, and they got reliable sources. They know what's going to actually go through right away. And the good broker is going to be able to tell you right away, this works or doesn't work on your particular project with the programs that they have. So you just want to watch out for the bad ones that don't tell you that right away, of course. So also understanding understanding the lender's down payment requirements, right? They're different across the board. So being able to know, hey, what is the loan to cost? And by cost, I mean purchase and renovation. Of course, there's other costs. There's interest, there's closing costs, there's lender fees, there's utilities, there's property taxes. There's a bunch of other costs in your project, but in a lender's eyes, they're looking at the total cost associated with a purchase, the purchase price, and the actual renovation as what your total cost is. And normally they will fund 85 to 90% of the purchase price, and then they will fund 100% of the rehab, sometimes 90%, but most of the time 100% of that renovation on the back end, so that way you know what to expect as far as the down payment goes, right? If you're trying to go through and understand how much capital you need to come up with for your project, knowing what that initial down payment is and what they'll fund on the purchase and rehab is key. Now, there's one more limitation on top of loan to cost limitation. You have loan to after repaired market value. So if you have a $100,000 property, for example, the lender's only going to max out at 65 to 75% of that market value of that $100,000 on the project as a whole. They will not fund more than that. So if your purchase price and your renovation amount are more than 65 to 75% of the market value, you want to be understand what to expect there. Now, some lenders fund up to 65%, some lenders fund up to 70, which I see most common, and some lenders fund up to 75%. It really depends on the market as a whole and what's going on in the general market to determine what the availability is of these different loan to values, depending on the company and what they'll work with. Usually the 75% loan to value type situation, they're much pickier on what they'll actually fund, versus the 70 and 65, they might be able to let a little bit better of a deal or a little bit worse of a deal go through than these, or not having everything perfect, versus the 75%. Usually that's earmarked for, experienced borrowers that know what they're doing on that side very much, and have high credit, high reserves type situation, versus someone that has maybe a little less experience on the 65 to 70% threshold. So knowing those two numbers, loan to cost and loan to value, with the lender you're dealing with, very important to understand, of course. And then understanding the lender fees, what's the closing costs involved from the lender side as well as the title side of things, what's your insurance going to cost as well, how much points the lender is going to charge, is there any prorations on the closing statement, so you can estimate accurately what your closing costs are going to be on the project as a whole. And then one big ticket item that people don't think about is after the fact, after the loan closes, what is their renovation draw process? Most hard money lenders come out and say, okay, we're going to go and wait till you front the money on the project. You're going to front maybe the first 10, 15, $20,000 on that project, depending on how large the renovation is. And then after you put that money up and the work is done, the lender is going to then reimburse you for the money that you put into the property, right? So that way they end up at the end of the day, at the end of the project, with a fully finished project, and you've already put in all the renovation costs for any overages. The lender doesn't do that, so they're looking to say, hey, this kitchen piece was in the budget for $10,000, but you're saying it's 15. Therefore, we're only paying 10 because that rest is overage for the kitchen that is your responsibility. So knowing up front that those overages above and beyond the original renovation bid that you actually put together is your responsibility as the borrower. That's usually the case. Now, there is a few lenders out there that will allow you to front money, a very small amount, usually $10,000 they might front on your deal, so that it makes the requirement a little bit easier. And a lot of the professional lenders like that, of course, because they can utilize the lender's money to get that stuff started, of course, and move forward with the contractors for those initial deposits and things like that. It's rare. It used to be a lot more common, but it's rare now across the board. So very important to understand, okay, what those draw processes look like, and as well as the fee structures involved. Normally there's an inspection fee. They're going to send out an inspector to go look at it, or they might have an inspection software where they allow you to take that inspection software, submit that along with pictures and receipts and things like that. That's also getting more and more common as people are using technology to make that, fast turnaround. Normally, if you have to send in an inspector, you're maybe a couple days out for the inspector and a couple of days back to get that information back, along with a couple of days to draw. So it could take 4 to 6 days to get your drawback if there's an inspection process involved. But if you're handling that and they allow you to do the inspections via the software and uploading yourself to their system, it can be a lot faster, of course, to get those funds out, because you're going directly to the lender in the first place that's going to review that documentation. And understanding what those fees are very key, as well as extension fees. If they give you a 6-month loan and you might need another 6 months or another 3 months, do they charge a fee for that extension at the end of 6 months? Or are they giving you a 1-year term type loan up front? What is the process there for extensions when that occurs? Knowing that up front is really important to your bottom line, because things go wrong on projects all the time, where it takes way longer to get a project done than you might believe in some of these cases. So also, looking at the timeline for closing and the bureaucracy that you have to deal with at the lender is key. So some lenders, we can close in 7 days, 14 days, and get it done really quick. We can do that. We have our own funds. Other lenders might take up to a month or so, because they're submitting them to these outside correspondent arms. And it all depends a lot of times if you, as the borrower, are actually buttoned up correctly and have all your ducks in a row and all your documentation as far as the requirements and the paperwork to get that ready, so that way you can be successful at getting your deal done as fast as you need. You need to have your renovation bids, have all your corporate docs, have all the documentation for that deal done up front and submitted, so that way the lender has everything they need to do the underwriting and pull the appraisal, because they can't order the appraisal until they have the full renovation bid, for example. And so sometimes those appraisals are the crutch that hurt with timing a lot of times, because the appraisers can get bogged down with a lot of work, of course. So, and then how resourceful is your lender in the first place? So we get a little creative sometimes. So we've done joint ventures with investors, especially when they get seller financing on different terms, where we'll come in and bring in the capital needed for a seller finance deal on a project. We've done some seconds every once in a while to help people with projects. How creative and how many resources does that lender have to be able to help you on those unique deals that don't fit in the square box, right? So they have sometimes lender minimums, lender maximums. There's things that don't fit. Maybe they're a rural property, but us as investors, as well as lenders, see opportunity in different ways and can close a deal when a lot of other lenders can't. And so being able to choose that right lender based on their resources and a lot of the things that I just went over on what makes a good hard money lender, and understanding their fee structures, their processes, their limitations on financing and financing sources, can be absolutely key to your success long-term in finding a quality team member that you can rely on every single time. Okay. Now, what are the scams out there? How to avoid all the craziness of the scam? So one of the biggest scams that I see out there is a due diligence fee, where people will require a due diligence fee in order to review your deal in the first place. Never pay a due diligence fee. In my eyes, it's a scam. Maybe I'm wrong, and there might be a few people out there that are reputable still doing a due diligence fee. But in my eyes, if I'm paying money to just get a quote in the first place, when I don't know if a lender will actually fund in the first place, something smells wrong to me and I'm running the other direction. So be very careful on those due diligence fees. Maybe if it's a massive deal and takes a ton of work to do, then okay, I might be able to understand their point there. But even then, I'd be going out to the lenders that don't have that type of fee structure involved, that still have a lot of the resources out there that are available. Okay. So now watch out for the rate and the bait and switch on the rates and the points and the fee structures involved, and the terms too. So you might get quoted one thing and then come to the closing table and see something completely different. So being able to make sure you understand what those fee structures are up front is really, really important. You don't want to get baited and switched into a bad loan when you got to get this thing closed right away. They know that, and they know you're a distressed buyer at that point. So being careful with those unscrupulous lenders that will do that is, of course, key. Okay. Lenders that require more money down than previously discussed. So they might give you an initial quote, and then when you come to the closing table, you owe a lot more money as far as your down payment goes. Now, if it's a couple thousand off or something like that, it's usually closing costs or insurance or something like that that's a little bit different. But normally, if you wanted to see very close to in line with what the original quote was, and whenever you get these quotes, make sure you put a little bit more buffer room on top of what the original is as far as capital requirements for that deal. Don't just rely on that exact number each time. It changes slightly before closing. Okay. So, and then lenders that don't have their own money, like I said, you want to be careful, make sure they are still closing deals consistently with those lenders, and that they know what the requirements are for those correspondent lenders that they're going to, or their note buyers that they're selling their notes to up front. So you're going to get that deal closed, and that they're going to reliable sources out there that aren't going to cause all kinds of undue headaches and hardships and stresses come the day of the closing on these projects, and making sure they're communicating right with the brokers, and the brokers are experienced and know what they're doing, of course, is really key. Okay. So now the last thing is actually how to compute your out-of-pocket costs. So the two things, like I mentioned previously, that you got to look at is, what is that lender's loan to value requirement? What's the maximum loan they're going to give you? Is it 65, 70, 75%? And so you're backing in your purchase and your renovation cost into that number to say, am I getting a haircut right here, even on my purchase and rehab right from the start? Now, what is their down payment requirement on the purchase price as far as loan to cost goes on that purchase price? Are they requiring me to put 10% down? And at that requirement, what does my loan look like? Now, what does my loan look like when with the after repaired market value? So you can compute what your down payment is, of course, and then looking at your renovation hold numbers. Do they have an interest hold that the lender's requiring on that project? What are the points and the closing costs and all those things, and are those estimated? So all these things are important to understand to compile your total cost of the project. Now, keep in mind also, they always want you to have reserves too. So normally you have to have money to front the renovation, and then you get reimbursed later along with renovation overages. You have to have your interest for the project. So whether the lender is holding it or you have it in your reserves, you're required to have that for the life of the project, so that way the lender knows that you can make these payments and aren't going to run out of money on your project, of course. So all of these things, along with the renovation reserves and the interest reserves and any renovation overages reserves, is key to being able to be successful. So if you're pricing this out about how much capital you're going to need for the project, I would use 65 to 70% of the after repaired market value and 85 to 90% of your purchase price as far as a down payment requirement, along with all those points, closing costs, and the interest reserve set aside. So if you're going out and getting money from private investors for these projects and gap filling your deal that way, you don't go under raise from these people in the first place. It's the last thing you ever want to do, is have to go back to your investor and ask them for more money on a project because you underbid what you think the total cost of that project is. Okay. So, and understanding these costs are absolutely key to being successful at your flip in the first place. And the hard money lender will be able to be there for you and be able to gap fill the rest of those funds on top of your investor funds or your own capital that you put in that deal in the first place. So I hope this gave a good overview for you guys on how to choose the right type of hard money lender for your flip, and some of the pitfalls and important things that you need to understand before you even get started with any hard money lender. Thanks so much, and I'll talk with you guys soon. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.